Since the symposium a year ago, the committee has raised the policy rate by 300 basis points, including 100 basis points over the past 7 months. And we have substantially reduced the size of our securities holdings. The wide range of estimates of these lags suggests that there may be significant further drag in the pipeline. Beyond these traditional sources of policy uncertainty, the supply and demand dislocations unique to this cycle raise further complications through their effects on inflation and labor market dynamics. For example, so far, job openings have declined substantially without increasing unemployment, a highly welcome but historically unusual result that appears to reflect large excess demand for labor. In addition, there is evidence that inflation has become more responsive to labor market tightness than was the case in recent decades. These changing dynamics may or may not persist, and this uncertainty underscores the need for agile policymaking. These uncertainties, both old and new, complicate our task of balancing the risk of tightening monetary policy too much against the risk of tightening too little. Doing too little could allow above target inflation to become entrenched and ultimately require monetary policy to wring more persistent inflation from the economy at a high cost to employment. Doing too much could also do unnecessary harm to the economy. As is often the case, we are navigating by the stars under cloudy skies. In such circumstances, risk management considerations are critical. At upcoming meetings, we will assess our progress based on the totality of the data and the evolving outlook and risks. Based on this assessment, we will proceed carefully as we decide whether to tighten further or instead to hold the policy rate constant and await further data. Restoring price stability is essential to achieving both sides of our dual mandate. We will need price stability to achieve a sustained period of strong labor market conditions that benefit all. And we will keep at it until the job is done. Thank you.
So based on what Jerome Powell at the Federal Reserve is saying and what they've been doing with their effective federal funds rate hikes to combat inflation, to bring it down, tons of people are telling you to get your money out of the banks now. Lots of people are even saying to get your money out of crypto now. So what should you do? There's a lot of confusion in the markets. By the end of this video, I'm going to be sharing with you what I'm personally doing. Again, this is not financial advice. Don't buy, don't sell anything. This is all educational purposes only. But what I do want to share with you is I want to share with you data on what's happening in the markets right now with XRP, with Bitcoin, with the total altcoin market cap based on where we are in this market cycle, the psychology of a market cycle, market trends, the fear and greed index. We're also going to be talking about miner capitulation and the profitability for miners. We're also going to be talking about where Bitcoin is in this market cycle compared to the past, what's most likely to happen next for Bitcoin, what's about to happen next for the stock market. We're discussing the 10-year to 2-year Treasury yield curve inversion, inflation and how that's going to affect your day-to-day life, what the Fed is most likely to do the rest of this year for their effective federal funds rate, what consumers are expecting for inflation and how that's going to affect the economy. And then also we're going to be discussing the unemployment rate and how this is leading to a massive crash that's on the horizon that you need to be ready for. So comment 777 if you're feeling blessed, comment 777 if you're feeling bullish, and if you're going to become the first millionaire in your family tree, you know what to do. Confirm it by liking this video and tapping that subscribe button. Let's run it. All right, bull runners, welcome back to the channel. So with XRP sitting at 50 cents right now, $26 billion market cap, Bitcoin sitting just above $26,000. You know, after the news of Grayscale's court win over the SEC, that brought some good news into the market. And we saw, you know, Bitcoin rally up from $25,900 all the way upwards of $28,000. But that rally was short-lived as we came back down on the right-hand side to back test this zone of support right here that Bitcoin's been consolidating at sideways. Now for XRP, you know, XRP broke to the downside below this upward trending support right here since August 23rd, so over the past week. And where XRP is going to go next, like I talked about in the previous video, will be based on what happens with Bitcoin. And so I'm going to get into the charts with you guys. I'm also going to be sharing a macro market outlook for you to understand what's going to happen next in the markets. And as we look at Bitcoin on the daily chart right here, well, on the hourly, we can see that Bitcoin is in drastic oversold territory at 20 on the RSI. And so, you know, don't buy Bitcoin, don't sell Bitcoin. But in terms of accumulation right now, tons of whales are accumulating Bitcoin. Bitcoin. They're getting their Bitcoin off of exchanges. They're getting their crypto out of centralized exchanges and into cold storage wallets. So by the end of this video, you're going to have an understanding of what I'm doing to prepare. But what I want to dive into, you guys, is some chart comparison to the past, because what we can look at to understand what could happen in the future is the past. But just because something happened in the past, it doesn't mean that it's going to happen again in the future. But it's good to look either way and give it a little lookaroo, a little look-ski to see what's going on here. So when we look back in 2019, we can see the 50 SMA in blue and the 200 SMA in red. When Bitcoin dipped below the 200 SMA, we saw a drop from around $10,000 all the way down to $7,700. So when we saw that dip take place, it was about a 25% drop. Now, when we saw Bitcoin has been above the 200 moving average since the rally out of the bottom, this bear market rally in January of 2023. So the fact that Bitcoin has been above the 200 moving average in red since January, February, March, April, May, June, July, August, for the better half of 8 months, well, this drop that took place for Bitcoin was about a 15% drop. Now, very interestingly enough, when we saw that drop happen back in 2019, we saw a rally back up to the 200 moving average right here, followed by a rejection and Bitcoin trading lower. Now we're seeing something similar happen. Bitcoin rallying up to the 200 moving average, rejection. Now, could we see Bitcoin dip lower back to this support zone that Bitcoin was in back in the 15th of June of 2023? Well, that's going to depend on what the Fed is going to be doing and the announcements that are coming up. But I do want to share something that's interesting with you guys. When you note and you look at this on the RSI right here for Bitcoin, when Bitcoin saw this dip, this was one of the biggest sell-offs for Bitcoin in terms of speed at which the rate and the velocity that it happened. And Bitcoin was all the way down to 23, 24 on this RSI on the right hand side of the chart that you can see right here. Now, very similarly, we saw the same thing happen back in 2019 over here on the left side of the chart, where Bitcoin dipped all the way down to 20. And so I talked about my prediction on what would happen next. And doesn't mean I'm right all the time. In fact, I'm wrong a lot of the times, and I'm very transparent about that with you guys, because you can't be right 100% of the time. But as long as you have a good finger on the pulse, on the trigger of what's going to happen in the economy, it'll give you a good idea on how to prepare. And so what I was expecting to happen was a bounce from oversold territory on Bitcoin on the daily, on the right-hand side, trade back up within this range right here on the RSI, followed by a rejection, and then consolidation sideways, another dip down, and then we break out of here. And so very similar to 2019, right? We saw a break to the downside. That would be like a back test of this support right here. And then we saw a spike for Bitcoin back up to the range that it was at before the drop right here, right? So that would be like Bitcoin spiking back up within this range at some point to about $29,000, $30,000 above the 200 moving average. We saw the 50 moving average and the 200 moving average cross right here. Very similarly, we see the 50 moving average turning bearish. The 200 moving average is coming up, and there could be an intersection here soon. And this intersection, interestingly enough, was right when Bitcoin rallied back in October of 2019. So the real question here is, for me, right, this is what I'm asking and what I'm curious about, that I'm looking into for you guys to understand, is will we see Bitcoin rally higher this year before we see a recession drop by 2024, or will the recession drop happen at the end of this year? So I feel like a drop is coming. Now the real question here is, will the drop happen around these levels right here, or will we see Bitcoin, push higher, and will we see a drop happen at these levels up here, with Bitcoin pushing higher, with the Federal Reserve, putting more money into the economy? At some point, there will be some type of crazy drop happening, and I'm going to be talking about why I feel that's going to take place based on all of this news you're going to see in this video, okay? And so 2019 is a comparison point. Now, a lot of people have been comparing Bitcoin as well too, to 2015. When we saw the 200 SMA cross below the 50 moving average, Bitcoin was rallying from $200 all the way up to $323. And we saw Bitcoin drop below the 50 moving average, drop below the 200 moving average, and form a low back down to about $200. It didn't quite come back down to this wick all the way down at $150, but it was pretty close to it. I mean, if we were to measure how far off we were, we were about 29-30% away from that. And so for Bitcoin on the right-hand side of the chart, where we are right now, we've seen the 200 moving average above the 50 moving average until it crossed in February of 2023 when we saw this massive rally for Bitcoin to the upside. Similarly, on the left-hand side of the chart, June of 2015, we saw Bitcoin rallying when it crossed. And then when Bitcoin dipped below the 50 moving average, then below the 200 moving average, we're now seeing Bitcoin dip below the 200 moving average again. And so the real question here is, if Bitcoin does not hold this support right here at about $25,000, this zone that acted as resistance in February of 2023, resistance in August of 2022, and then also support in May of 2022, if it does not hold this as support, we break to the downside, I would expect Bitcoin to drop all the way down between $19,000 to about $21,000 within this range right here. And so as long as we hold this support, I'm bullish. If we break this support, I'm bearish in the short term. But overall, I'm macro bullish for Bitcoin because I believe even with volatility happening this year, I believe the news about the ETFs, the news about the GDP growing, the news about the gross debt growing, and the amount of money that's going in the economy, regardless of a dip, the markets for crypto is looking a lot more bullish than the dollar. Now, looking right here, when we compare the total three in terms of crypto total market cap, excluding Bitcoin and Ethereum, where we can see we were from the high. Now, I'm not talking about the all-time high because one thing that's interesting to note, if I pull up Google Trends for you guys to look at this, is you guys can see, right, the peak of interest. This shows how many people are searching on Google. When the people were typing in Bitcoin in December of 2017, it was at 100 out of 100. And so that was the high for Bitcoin. Now, by the time we hit the dead cat bounce for Bitcoin right here in April of 2018 on the chart, everyone was pretty much out of the market in terms of interest right here. June or April, we go to March, April, it was about 16 out of 100. So virtually nobody cared about Bitcoin anymore because Bitcoin saw that massive drop. Now, similarly, when were people the most interested in Bitcoin and crypto for this last bull market rally? Well, February of 2021 is a 52 out of 100. So when we go to the chart right here and we see where we were in February of 2021, we were right here. Bitcoin was at a $200 billion market cap. We weren't even at that first peak. And so by the time we hit, May of 2021 for that first peak for Bitcoin, we were already right here. We were already on the downtrend. And so when Bitcoin formed the all-time high, almost not everybody, but virtually everybody was losing interest in the markets. November of 2021. So on Google Trends, by November of 2021, we were at a 26 out of 100 in terms of interest compared to a 52 out of 100. Dead cat bounce for Bitcoin was higher than the actual high. So if we were to measure for the total altcoin market cap from the high of May of 2021, that's like measuring from the high of January of 2018. And so we're roughly 840 days, give or take a day or two if I were to zoom in exactly. But the drop from the high, right, to the low is about 74%. Now comparing the high to the low of December 2018 is about 92%. So we're about 20% off, from the low, from how low the altcoin market realistically could go. So where I feel that we are in this market cycle is we're within a range right around here where the volatility that's taking place, right? If we see a rally up for crypto, right, out of this range to fake everyone out, I would expect a massive dip after that. Now, the real question is if we just kind of waddle sideways with what the Fed's doing and we see a dip to shake everybody out one final time, one final capitulation event, anger, depression, and then we start working our way out of here in 2024 or 2025, because when we look at the psychology of a market cycle, right, you see euphoria, complacency for a dead cat bounce. Complacency for the dead cat bounce in this last market cycle for Bitcoin was right here in this stage right here when Bitcoin went up to, the market cap went up to above 1 trillion. And then we saw the drop with FTX, Terra Luna collapse, all that stuff right here. This was complacency. Then anxiety, denial, panic. Right here, anxiety, denial, panic. Then we saw capitulation take place. Anger right here from one final drop, then depression before the next disbelief rally right there. And so where are we right now? Well, we could arguably not arguably, we are in the capitulation stage right now. So we're in capitulation. Have we really hit the anger stage yet? When we look at the fear and greed index, we're at neutral right now. So people aren't in extreme fear. They're neutral. They don't know what's going to happen right now. So my opinion here is there's another drop coming on the horizon right here, based on comparing this right here on the right hand side of the psychology of a market cycle. One final shakeout event could be coming for the altcoin market, an altcoin reckoning, a massive disaster, based on what I'm going to be sharing with you for the rest of this video. So another dip coming. Now, how low will that dip happen? That's anyone's guess, and you just have to be ready for that. Very similar to, people thought that this was the low right here at $36 billion back in December of 2019. We rallied out of this, broke the 50 and the 200, faked everyone out for that rally, and then the COVID crash right there, and then building out of the COVID crash with artificial stimulus, artificial inflation, the CARES Act, over $2 trillion pumped into the economy. And this whole bull market rally was inflated, right? It was artificially inflated. Now, it doesn't mean that crypto is artificial. It's the underlying technology behind crypto that the money was moving into. And then the blockchain technology still being too early for the world to adopt, right? And the central banks not being ready for distributed ledger technology for CBDCs yet. Well, by the end of this year, once they start ushering in their CBDC plan, the digital currency plan, capital controls, and then, lockdowns and all of that stuff coming on the horizon, then we'll most likely see massive volatility. Even if we see a spike up and a rally up, I expect that to be a fake out, to drop back down, to fake everybody out, and for us to be somewhere within this range right here on the left-hand side, based on where we're at. And so another dip coming. Now, I could be wrong, and we could rally out of here, and there could not be one final dip. We could see something like this take place, where just massive volatility, but we just keep pushing higher, and we don't see another low for the altcoin market. In that case, I'm holding, XRP, I'm holding Bitcoin, I'm holding some Ethereum, and I'm holding the ISO compliant projects, making sure that, I do have some of my portfolio allocated to the crypto market just to hold. But at the same time too, I'm not overly investing right now, thinking that we're already at the low because of what the Fed is talking about, the psychology of a market cycle leading more towards an anger event, where it's like, who shorted the market? Why did the government allow this to happen? One final event, why did the Fed allow this to happen? I expect that to be taking place for everybody. And also, when we look at minor capitulation right here compared to the past, in terms of blocks since difficulty bottom, on how expensive it is for miners compared to where we were. Well, if I go back to, December of 2018, and then also we go back to about April of 2015, and we compare that on the chart for where we were, right when we saw the blocks since difficulty bottom shift from about 196,000 down to 0, and then it being more profitable for miners to jump in the market, we saw this take place for Bitcoin. Bitcoin rallied up from $3,400 all the way up to $4,300, and then right when it flipped, we saw one final dip happen for Bitcoin at that anger event right there, and then we just kind of traded sideways and then rallied out of that. Now, I don't think we're at this stage right here, but it's very interesting to note that in 2015, we saw the low come before that period, and Bitcoin see one rally after it flipped, and then another final dip for Bitcoin. So on both of these scenarios, after the block since difficulty bottom shifted from around 200,000 down to 0, in both cases, after that happened, we saw another dip for Bitcoin. Now, for 2015's case, the bottom was in before. For 2018's case, the bottom came in after for that dip. But either way, in 2015, even if we see a rally for Bitcoin, we saw another dip happen pre-halving year. And so before Bitcoin halves, then after Bitcoin's halving, then Bitcoin sees a bull run. So Bitcoin hasn't halved yet. So all that I'm expecting for the rest of this year is just massive volatility, another dip. Even if we push higher, it would be a fake out event, in my opinion. And then something would happen within the economy with unemployment spiking back up. And we see Bitcoin see another drop back down within $19,000 to $20,000. And then we break out of there. I don't think we go any lower than that. That would be the lowest that I think Bitcoin would go. If we would see a double bottom for Bitcoin, the thing that would cause a double bottom for Bitcoin would be a global worldwide pandemic. That's what would cause it. So that's not out of the books just yet, right? It happened in the past, so it could happen in the future, but it doesn't mean that it will. All that this means is you have to be ready. That's all that means, okay? You can't predict that it will happen. You just have to prepare for what's in your control, right? The moment that you're focusing on what's out of your control and you're like, well, if you're telling yourself, it can't happen again, right? That's ignorant right there. But if you're telling yourself it could happen again, I don't know when, but if it does, right? If it does, what am I doing to prepare? That's smart preparation right there. So I'm preparing for an absolute shakeout event for Bitcoin back down to 15K, but I don't think that will happen. I think the lowest that it would go would be 19 to 21K. Again, I could be wrong. It could go lower. I could even be wrong about 19 to 21K, and we could just break out of here and break the high. You have to be flexible with your approach here. You can't be stagnant and say that this is the way that it's going to be and that's it, period, because the Fed has to adjust their policy stance and they have to adjust what they're going to be doing with the effective federal funds rate. So I'll be keeping you guys updated on this channel. But one thing that's interesting to note is when we talk about the correlation between crypto and the stock market, and then we look at something like the S&P 500 compared to the past on what happened back in 1976, we can't compare what's happening right now in the markets to 2007, 2008, or 2000 for the dot-com bubble crash, because when we look at the yield curve inversion, we weren't this low during those periods right there, right? 2006, we only got down to negative 0.11. Right now, we're at negative 0.78 between the 10-year and the 2-year, the bonds right here. And so back in the year 2000, we were at negative 0.45 and we bounced out of there. So it was a little closer, but back to 1980 is when they were raising the effective federal funds rate through the roof. And so we're at a different time period right here, completely different than 2008. And it's artificially created by low rates, massive stimulus, massive QE, quantitative easing, and then jacking up the rates really quick. And that's going to throw the economy into a tailspin. So when we saw the crash take place was not when we went inverted on the yield. I've talked about this in previous videos. It's when we went from inverted to drastically in the positive territory and we saw a spike up that we saw the crash happen after that, right? So that's why a lot of people are saying a bigger crash is on the horizon, because we're still in negative territory. So that means that when we go back here, right, and we look at 1978 when we went inverted back here, and we go to the chart of 1978 when we started going inverted, that's when the stock market right here was at 86 on the S&P 500. Okay, well, interestingly enough, if we mark when we went inverted in about June of 2022 to July, right here, this vertical yellow line, that's when we saw close to a bottom for the stock market. The bottom came after that, but the bottom came before that back in 1978. But what's interesting is if I draw the Fibonacci retracement tool from the high of 1976 to the low of 1978, and I do the same thing from the high of 2021 to the low of October of 2022, we've done a 786 retracement a little bit above that. We did above a 786 retracement as well too before we saw another drop take place in November of 1978. And so the S&P 500 pushed up to the all-time high and dropped down below the 200 moving average, about a 15% drop before rallying out of there. And so I do feel that the stock market could push higher. I do feel that Bitcoin could push a little bit higher, similar to what happened right here back in 2019, where we saw Bitcoin see a spike above the 200 moving average right in the 26th of October, and it held it all the way until the 7th of November before dropping to the downside. So if we were to see something like that happen for the crypto market, for the stock market, I would expect the S&P 500 to potentially push up to the all-time high of 4,800, maybe even higher than that. And then for us to see a dip either at the end of this year or the beginning of 2024, and then working our way out of here as the Fed steps back in to issue QE to print their way out of the problem, but ultimately massive volatility over the next few years before we even consider rallying even past the all-time high. Because with Jerome Powell's goal for inflation being 2%, well, we were at 3% in June. We're at 3.2% higher in July. So the likelihood of them raising the effective federal funds rate again is very, very high to bring inflation back down to 2%, because why would they lower it if inflation has gone up? It just doesn't make any sense. And with the fastest rate hikes in history right here, everyone's waiting for something to break in the banks, because when we see it sitting above 5% right now, well, the real estate market's in for a reckoning, the stock market's in for a reckoning. It's on the horizon though. So yes, a lot of people are saying that, what are you talking about? We're going higher. Yeah, I think we are going higher, but the crash that's coming after that is just going to be much bigger. So it's like they're delaying the collapse of the house of cards. Like they keep pulling stuff out in terms of Jenga by tightening on their Fed balance sheet and restricting their bond purchases and all of that and raising the effective federal funds rate. But at some point, they're going to have to, push more money back into the economy. So it's kind of like they're damned if they do, they're damned if they don't. So even if the Fed does not lift the borrowing costs in a few weeks, policymakers will release a fresh set of economic projections that will show both whether they still expect to nudge rates higher higher this year, and by how much they expect inflation to slow both by the end of 2023 into 2024. So historically, the crash doesn't come when they're raising rates. The crash comes when they pause on the rates and they pivot and they start lowering the rates. And then they have to usher in more stimulus, they have to usher in more quantitative easing, and they have to print their way out of the problem. And so right here, also, when we look at the unemployment rate sitting at about 3.5% right here, you guys can see historically in the past, right before any sort of crash, like if we do look at 2007 to 2009, the unemployment rate went from 4.4 all the way up to 9.9%. If we look at the crash of 2020, it went from 3.6 upwards of the highest that it's been, during the lockdowns and the pandemic in April of 2020. If we look back to the year 2000, it went from 3.9 up to 6%. Right now, we're at historic lows right here. So based on the tides of the seas going up, going down, it's very easy to see, just based on where we're at right now, that we're most likely not going lower on the unemployment rate. So what does that mean? It means that we're most likely gonna go higher. And now the real question is, what happens when we go higher on the unemployment rate? What happens for that? Well, the level at which unemployment equals positive output is highly debated for the economy, because economists suggest that the US unemployment rate gets below. If it gets below 5%, the economy is very close to or at full capacity. So at 3.5%, one could argue the level of unemployment is too low and that the US economy is being inefficient. And that is exactly what's happening right now. The economy is being very, very inefficient. The cost of living is out of control. To take out a mortgage for a home, the interest rates are too high. And so if you're spending money, the value of the dollar is going down in value. And if we look right here at the Center for Health Security, this was a tabletop exercise that they ran called Catastrophic Contagion. And this is all public information, guys. This is just being spread everywhere. The Johns Hopkins Center for Health Security, in partnership with who? Bill and Melinda Gates Foundation, conducted Catastrophic Contagion, which was a tabletop exercises back in October of 2022. And they said that this was bringing health officials from Senegal, Nigeria, Angola, Liberia, Singapore, India, Germany, as well as Bill Gates, co-chair, founder of Bill and Melinda Gates Foundation. The exercise simulated a series of health emergencies for a fictional pandemic set in the future, right? Fictional, okay? So this isn't real, it's fictional. Participants grapple with how to respond to an epidemic located in one part of the world that spreads rapidly. Now, this right here, planning for something, this right here, if they're getting together to plan for it, could that be what causes another massive dip, another massive crash? One final shakeout event for the altcoins, one final shakeout event for Bitcoin, one final drop to $19,000, potentially a double bottom. Could that be what happens by the end of this year? Early 2024, before Bitcoin's halving, then Bitcoin's halves, then the Fed has to pivot, right, after they've lowered, and then they have to start raising the rates again. Could that be what causes all of this? I think it would be crazy. But that's just what I feel is going to happen. I'm curious on your guys' thoughts. If you agree, if you think there's one final shakeout event coming for Bitcoin, followed by just massive volatility, and then once Bitcoin halves, then the Fed has to put more money into the economy to try and save the United States, ultimately destroying the dollar, leading to digital currencies, global CBDCs being implemented. CBDCs are already coming, and the technology behind it is distributed ledger technology. And all signs are leading to Ripple and potentially XRP as that cross-bridge currency. So even if we see XRP break below the 200 moving average and we see XRP drop back down with Bitcoin, if Bitcoin sees a shakeout event and we see XRP drop, 29, 30 cents, what would you be doing at these levels for XRP, knowing that Ripple as a company is launching the CBDCs for a lot of these central banks? And if it accrues just 10% of the global GDP, or all this money that's being transferred for derivatives, that's like 10 trillion, $15 trillion. And the current market cap of XRP right now is only $27 billion. So what I feel is coming is the elite are preparing for a shakeout event. They don't want you to get rich. They don't want you to get wealthy. They want to shake you out of your position. The elite comes in, backs up the truck, BlackRock, their ETF gets approved. And then all of a sudden now everyone's starting to FOMO into the market as we rally out of these levels and we start to retest the highs of 2021 and then ultimately the high for XRP of 2018. Either way, what I'm doing to prepare is backing up my truck all the way to the bank, grabbing the bags, packing them and stacking them, leaving no bags left behind because the spending power of the dollar continues to go down in value. That's a fact. Blockchain technology is going up in value. That's the truth. And together, we're all going camping on the beaches of the moon. I will see you on the next video. I will see you on bullrunners.com, where you'll learn our #1 way to prepare for what's yet to come in the economy. As always, I'll see you on the next video. I'll see you on bullrunners.com. You know what to do. Stay bullish.